Tom Lee is out with a new bombshell interview today on CNBC and says the bottoms are in, and there's many reasons to expect that. He goes on to say that tariffs are likely not going to be as bad as expected, probably get delayed, and or deals will be cut before April 2nd, and this market is vulnerable to positive surprises. Take a listen to this.
Next guest says the Fed put is alive and well, and that's one of 4 positive signs he's seeing for the markets this week. Joining us is FundStrat's head of research, Tom Lee, also a CNBC contributor. Tom, it's good to have you, and let's just kind of start with that theme, and maybe you can build on what Steve just told us. How do you interpret the Fed's move yesterday? Welcome.
Well, I think markets were positively surprised by the Fed's move, in part because recent staff papers from the Fed had argued tariffs would actually be multi-year inflationary effects. So Fed Chair Powell's comments yesterday, I think, did catch a lot of folks by surprise, just because it is a view that markets probably want to hear, that they'd like to hear that the Fed is viewing tariffs as possibly transitory, because that puts them in a position to actually intervene if labor markets start to weaken. And in fact, that's evident in the SEP, because 90% of Fed staffers now see not only risk to growth, the GDP growth forecast, but it was 90% seeing it as downside risk.
Steve, would you agree with that characterization, or how do you think the Fed or Goolsbee or a member like that might respond to the idea that they're still at the ready to support the economy?
They're at the ready to support the economy through keeping rates where they are right now. He kind of took off the table, or never has put on the table, this idea of hiking rates. I think it's a difficult and very interesting dance the Fed has to do here. I think there's an argument, and people I've talked to have supported this, of the Fed talking tough right now about inflation to make sure and play a role in the idea that the tariffs do not become have a broader inflationary effect, but then being ready as needed to address the downside. Right now, it seems like, because Powell feels like he's restrictive enough to deal with that inflation problem, that all the talk or the leaning here is addressing the potential negative effects of the tariffs, and the idea that they both brought down their growth forecast while they raised the inflation forecast. If this were the Volcker Fed or the Volcker idea, Kelly, you would say that Paul Volcker would be addressing the inflation problem and then get to the growth problem.
Right, and Powell repeatedly says Volcker's the Fed chair that he kind of admires the most.
Yeah.
Granted, the inflation back then was very different than what we're dealing with now. Tom, even as the markets are digesting what Steve said, this kind of lower growth, stickier inflation environment, and not taking it all that well, what are the other positive signs you're seeing for stocks this week?
Well, I think that the sort of the big elephant in the room has been the absolute fear that has become systematic in markets around April 2nd and the tariff deadlines. And I think that there have been little hints this week that instead of April 2nd being the date of some sort of annihilation of trade relationships, that we may start to see either deals before then or even delays in implementation. And I think that really investors are going to breathe a sigh of relief, because, as you can tell, pessimism has become very pervasive because of the fears of what will happen on April 2. So I think that's a positive. And then the other is, and it's really a technical perspective, but Mark Newton, our head of technical strategy, has pointed out there are increasing signs of that we've actually established a tradable bottom. And that's not only the fact that we declined so quickly, but it's that market breadth has really been expanding and then actually following through in a way that looks like this is not a 10% decline that's leading to a 20%, but a 10% waterfall decline / heart attack for stocks driven by rage selling, and now it's tradable.
So those would be a couple of big positives, kind of technical signs, maybe April 2nd, because I've seen that reporting too, where they're, the White House evidently working with trading partners, trying to get some stuff dialed back before April 2nd and so forth. What else, Tom, do you see that encourages you?
Well, I'd say that probably the final thing that I've seen is, and this is really from our meeting with clients, is that we know there's actually quite a lot of dry powder. Many of our clients have raised a lot of cash. I mean, it's also evident in a lot of the money market balances or prime brokerage de-risking that's taken place. And it's at a time when investor sentiment has moved far more than is justified by the market moves. Whether you look at AAII or Investors Intelligence, both have registered recession-like readings and sentiment. And so it really creates the room for positive surprise. And that, again, I think it'll, like what you just said, if tariff headlines aren't as bearish, and if there's all this last-minute work on negotiating something, and yesterday there was a tweet about how into the night Hessett and Lutnick and Bessent were, working on a trade deal. That got so little notice. I think it just tells me markets could be positively surprised.
Donald Trump says the Fed should cut rates to ease the economy's transition to his tariffs. Donald Trump says, quote, the Fed would be, in caps, much better off, in caps, cutting rates as U.S. tariffs start to transition or ease their way into the economy. Trump wrote, quote, do the right thing. April 2nd is Liberation Day in America. This comes after Powell indicated that these tariffs could raise inflation in the short term, but the impacts then would recede over time. Jerome Powell called this, quote, the base case, but we can't really know that. And part of the reason why stocks rallied yesterday after Powell is Powell made it clear that he will not sacrifice the economy if tariffs cause short-term inflation. Jerome Powell effectively said this next round of inflation via tariffs will be transitory. Now, I don't know how I feel about that, but it's true. Tariff inflation will be transitory. But Jerome Powell also went on to say that if tariffs historically lower growth and raise inflation, the two should offset each other. And Jerome Powell used the word uncertainty like 30 times in the press conference yesterday, maybe even more than that. And that really just goes to show they have no idea what's going to happen next. We have a pretty well understanding of how tariffs should impact inflation, but they don't know. And we have really no idea how the economy is going to unfold from here. Jerome Powell himself said the soft data, like surveys and ISMs, and because ISMs, PMIs, they're survey data, right, have, quote, fallen off a cliff, but that is not translated into hard data. You can make the argument that hard data just works with more of a lag, and that some of that falling off the cliff, if you will, could translate into hard data. And that's why the Fed is uncertain, and they want to be available to help markets, to help the economy if they need to. Let's really think about that. If the Fed is in a place where they need to really start to cut rates, is that a positive? And I think that's why the markets are a little confused right now. Because yes, if the economy weakens, we're going to get rate cuts. That's great. But what does the economy weakening mean for earnings, corporate America, and valuations? That's what Wall Street's trying to figure out today. But I think the simple reason why markets did well yesterday was Jerome Powell completely flip-flopped from December 18th, where Powell was way more concerned about inflation, and now Powell is equally as concerned about the economy, or ready to help the markets if he needs to. That was not something we really expected out of Powell. Effectively, the Powell put is back. But before you get the Powell put, things tend to get worse before they get better. And that's why the markets are selling off a bit today. As I said yesterday, if there was a reason for markets to continue with a quote-unquote bear market bounce, because that's ultimately what I think this is, a dead cat rally, whatever you want to call it, this is not a holdable level. I do think stocks will fall further from here because, again, the Fed's worried about weakness in the economy. Even Donald Trump today suggesting the Fed should cut rates is suggestive that the economy is going to get worse before it gets better. And that is not necessarily good for stocks. Like even COVID, for an example. The Fed cut rates to 0 on a Sunday, and then the markets crashed after that. Because, again, the Fed can only do so much. If the economy is going to shit anyways, yeah, sure, the Fed cutting rates helps a lot, but the economy is still going to shit anyways. And markets proceeded to crash after the Fed cut rates to 0. Again, on a Sunday. That was the last emergency Fed rate cut situation that we've seen. So again, long story short, the Fed is your friend, but at the consequence of what? The economy getting weaker? So sure, the Fed being your friend is a positive for markets, but until we know what the economy looks like, it's only so much of a positive. Like, it's not the reason markets could rally to all-time highs here. As you see today, stocks are under pressure because you also have the other side of things, which is the economy weakening. It would be like if Powell came out and cut rates yesterday. If Powell came out and gave us a surprise rate cut, that's okay, one thing, we got a rate cut, which in theory should be good, but markets would have panicked. It would have been probably a 5% down day, because what in the hell does the Fed see that has Wall Street concerned? The Fed is your friend, sure, but what they're indicating is negative. That's kind of where we are now. The Fed saying they're not concerned about inflation, essentially they're more concerned about the economy, is like, what do they see out there? Why do they not care about inflation and they're more concerned about the economy? We did have a 10-year TIPS bid to cover actual of 2.35%. The previous auction was 2.48%. Now, this is a 10-year Treasury inflation protected security. So this is one of the ways the Fed measures break-even forecast for the long term. And they went down from the last auction we had. So that is a good sign. She also says the Canadian economy managed a soft landing. Unfortunately, we're not going to stay on the tarmac for long. Yikes, that does not sound good. And, it's kind of ignorant for a lot of, Wall Street investors here in America to say, oh yeah, Canada is going to do terrible. Mexico's probably going into recession too, but the US is going to do just fine. No, I've showed this to you guys a couple times here on the channel. But if you overlay the unemployment rate with the Canadian unemployment rate, you can see that they tend to follow each other. So this is the Canadian unemployment rate. They follow each other, right? Like literally almost perfectly. Now, sometimes theirs are higher than us. Sometimes we're higher than them. But you get the idea. We go into recessions at the same time. Unemployment rates spike at the same time. The Bank of Canada is saying, we have an issue. We are going into a recession. And that is not something we should ignore. Now, does that guarantee that we're also going to go into recession? Not necessarily, but historically, yes. Historically, yes. During the dot-com bubble, there was less of a correlation between Canada and the US because, a lot of the tech innovation takes place in the US versus Canada. But still, our economies are very similar, like surprisingly similar. Like 70% of their economy is people spending money, right? 15 to 20% is manufacturing. Most of it is services. Our economies are almost identical on paper. Obviously, workforce size, there's differences. But what makes up the economies are pretty much the same. So to say that Canada is going to go into a recession and we're not, kind of a fool's game. But she also does say there remains too many unknowns about tariffs to predict what happens next. She also says that may also mean acting quickly when things crystallize, but we need to be flexible and adaptable. That is what Jerome Powell made clear yesterday as well. That once things become clear, they are willing to act fast. If the economy, the hard data starts to actually reflect the soft data, and if things start to look like we're going off a cliff, Jerome Powell will act almost immediately. Same thing the Bank of Canada is saying as well. And I think give it a couple of months, and we're gonna know why Powell was more concerned about the economy, because it's probably gonna get worse from here before it gets better. I mean, Trump said that, Bessent said that. There's no reason why we wouldn't think that is true at this point. OPEC Plus today says new plan for compensation cuts runs through June of 2026. And this cut represents 189,000 to 435,000 barrels per day. The US leading index change month over month came in at negative 0.3%. The forecast was negative 0.2%, and previous was negative 0.3%. So again, not great. U.S. February existing home sales climbed to 4.26 million versus estimates of 3.95 million. And initial jobless claims today came in at 223,000 versus last week's 221,000 and the estimated 224,000. So 1,000 weaker than expected, but higher than last week, that's for sure. Nick Timmerhouse on X says the jobless claims data continue to show a picture of a somewhat less tight labor market compared to the last few years, but not one that is imminently getting meaningfully weaker. And you can see the different years here where you tend to get this spike, you know, right about now as is, right? So we'll see where things go. I'm not optimistic, and I'll just tell you that right now. Reason why I believed the U.S. economy avoided a recession in 2022 was all of the government spending. It was such a stimulative measure on the economy, whether it's the 3 million government employees or it's the likely 10 million employees that work for companies that get a majority of their funding from the government via contracts and just funny money being sent out, okay, grants or what have you. There's a lot of uncertainty now and potentially 13 to 15 million workers in the economy that one weighs on sentiment, which reduces spending in and of itself, but also actual government cutbacks could be an issue for the labor market for these individuals. And from that point, what are the knock-on effects from all less government spending or even perceived less government spending? If you are a contract company, let's say, and you get 50% of your revenue from the government and you don't know if that's going to be canceled a week from now, you're not doing that much hiring, you're not doing that much capital investing, okay? You're probably on pause right now, which pause is pretty much step one towards recession. And I don't see that easing up anytime soon. And trust me, these things need to happen. We have to get off of the, government spending spree that we've been on, or we were going to have a financial crisis. Like, that is true. Scott Besson is correct. I think it would have taken 10 years probably. Like, it was not something that was going to happen next month by any means. But there is going to be a recession to rectify that. Question is when, how deep, does it hit corporate margins? Is it just a more technical recession in nature? That is what we have no idea on. And that's really going to dictate what happens broadly to markets. And we can see today, Philadelphia Fed Manufacturing Index came in at 12.5. Last month was 18.1 versus estimates of 8.5. So a deceleration from last month, but better than expected. Business conditions absolutely plummeted from last month's 27.8 down to 5.6. CapEx index also fell from 14.00 down to 13.40. Employment went from 5.3 to 19.7. New orders plummeted from 21.9 to 8.7. And prices paid went up from 40.50 to 48.30. Again, very weird data. Not exactly sure what you make out of that. Some data points are really bad and some are, really good in that. So I think with noisy data like that, markets didn't pay too much attention to it. So that was the stack of data that we had today. Tomorrow, you really don't have much. You have a speech from Fed Williams, but that's pretty much it. Now, Bank of Canada's Governor McLean says we're not talking about double-digit inflation and double-digit unemployment. So they say it's not going to be too bad on either the inflation side or the unemployment side, but it could get worse from here. She also says we're going to proceed carefully to provide support to the economy, but without taking our eye off the ball of managing inflation. And how's this for adding a new issue for markets? Israel and the U.S. will hold strategic talks on the Iranian nuclear issue at the White House next week. Now, part of the good news today for markets, the European Union delays implementing first retaliatory tariffs on U.S. goods to the middle of April. So again, with all of this going on, it's hard for me to be bullish here, okay? Because there is so much downside risk and what I view as little upside risk. It's going to take some time for the economy to evolve away from government spending. It's going to take some time for tariffs to be worked out and for companies to figure out how to weather the cost of tariffs. These things are not going to happen overnight. And I don't see the trade war just going away like it did 2017, 2018. So from that perspective, I think the upside is limited and the downside could be massive. Like if you were to go into a recession, if you will, you could easily visit the lows of 2022, which would be from here over 40% downside. I mean, let's not even talk about like pre-COVID levels, right? Let's not talk about going back to 2020 levels, which would theoretically put you down like 45% or so. You know, those are possible outcomes here. And I don't think we're really ready for that, nor positioned for that. Also, part of the issue I see now is markets have bounced a couple percent, like from the lows until now. You've bounced about 3%, but look what's happened. The RSI is reset. It's currently at 41. You could now flush to new lows and markets would not be nearly as oversold as they were just when you were at those lows, like March 13th, March 14th. Right? So you've reset your momentum indicators where now you can fall again without getting overstretched. You can also see this reflected pretty well in the VIX, right? The VIX went up a lot. Now it came down a lot. You never really got that capitulation, that freak out moment. And I'm just looking at the UVXY here on chart. You went up a bit, but not to a panic level, not like what we had, you know, August 5th, for an example. And now you're right back down again. You could see the VIX spike again, not even to the highs of where it was again, March 13th, March 14th, March 11th, and markets would be at a new low. Okay, so it's a dangerous setup that we are in right now. Unless we can break above that 200-day moving average, you're in the danger zone. If you can break above that 200-day moving average, then you want to test that 50 and 100-day moving average around 591 or so. So let me know what you guys think about this down below in the comment section. We do have some earnings today as well in after hours. You have Nike, you have FedEx, and Micron. So they're all going to be important kind of for their own respects. Micron AI, Nike consumer discretionary, FedEx kind of a bellwether to the economy. Okay, so I think that could also be important to kind of drive the narrative. Ladies and gentlemen, let me know what you think about all of this down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.